The collapse of Lehman Brothers in September 2008 is widely regarded as the tipping point of the global financial crisis. What began as instability in the U.S. housing market quickly spiraled into a full-scale economic meltdown, shaking the financial systems of countries around the world. To understand how this happened, it's important to explore the rise of Lehman Brothers, the conditions that led to its downfall, and the broader consequences that followed. The rise of Lehman Brothers. Founded in 1850, Lehman Brothers began as a modest commodities trading business in Alabama, dealing primarily in cotton during the early years of the American economy. Over time, the firm steadily evolved, expanding into financial services and eventually becoming a key player in investment banking. Its growth mirrored the rise of the United States as a global economic power. Across more than a century, Lehman Brothers demonstrated remarkable resilience. It survived major historical disruptions, including economic downturns, global conflicts, and the devastating impact of the Great Depression. Through adaptation and strategic expansion, the firm positioned itself at the center of modern finance. By the late 20th and early 21st centuries, Lehman Brothers had firmly established itself on Wall Street as one of the leading investment banks. Its operations spanned investment banking, fixed income trading, equities, and asset management. The firm played a significant role in underwriting securities, advising corporations, and managing large-scale financial transactions. As financial markets evolved, Lehman increasingly shifted its focus towards structured finance, particularly mortgage-related products. During the early 2000s, the U.S. housing market was booming, and Lehman saw an opportunity for significant profit. Like many of its competitors, it expanded aggressively into mortgage-backed securities, which were generating high returns in a rising market. This strategic shift, while profitable in the short term, would later expose the firm to significant risk as market conditions changed. The housing bubble and risky lending. In the years leading up to 2008, the United States experienced a dramatic housing boom. Property values surged as demand for home ownership increased, fueled by low interest rates, easy access to credit, and widespread optimism that housing prices would continue to rise indefinitely. Banks and lenders began issuing mortgages at an unprecedented pace. Importantly, many of these loans were extended to borrowers with weak credit profiles, limited income verification, or high levels of existing debt. These high-risk loans became known as subprime mortgages. Rather than holding these mortgages on their own balance sheets, financial institutions, including Lehman Brothers, packaged them into complex financial instruments. These included mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, which were then sold to investors globally. These products were often given high credit ratings, despite being built on risky underlying loans. As a result, they appeared attractive to investors seeking higher returns, and demand for them grew rapidly. This demand, in turn, encouraged even more lending, further inflating the housing bubble. However, the system was built on fragile assumptions. It relied heavily on continuously rising home prices and the ability of borrowers to meet their mortgage payments. When housing prices began to level off and eventually decline, the foundation started to crack. Borrowers who had taken out adjustable rate or high-risk mortgages began to struggle with repayments. Defaults increased and foreclosures rose sharply. As more homeowners failed to meet their obligations, the value of mortgage-backed securities and related financial products dropped significantly. What had once been seen as safe, high-yield investments quickly became sources of massive losses. Because these securities were widely held across the financial system, the impact spread rapidly, setting the stage for one of the most severe financial crises in modern history. Lehman's exposure to risk. At the heart of Lehman Brothers' downfall was its deep and concentrated exposure to mortgage-related assets, particularly those tied to the most vulnerable segments of the housing market. During the housing boom, Lehman aggressively expanded its position in mortgage-backed securities and complex derivatives, believing the market would continue to rise or, at worst, stabilize. Unlike some of its competitors, Lehman was slow to recognize the severity of the shifting market conditions. While other major firms began reducing their exposure to subprime mortgages and related assets as early warning signs appeared, Lehman continued to hold, and in some cases increase, its positions. This left the firm dangerously exposed when housing prices began to fall and mortgage defaults surged. A critical factor that magnified Lehman's vulnerability was its heavy use of leverage. The firm relied extensively on borrowed money to finance its investments, operating with a very high debt-to-equity ratio. In favorable conditions, this strategy boosted profits and returns. However, it also meant that even relatively small declines in asset values could result in disproportionately large losses. When the housing market began to deteriorate, the value of Lehman's mortgage-related holdings dropped sharply. As losses mounted, the firm faced increasing pressure from creditors and counterparties. Its financial position weakened rapidly, and concerns about its solvency began to spread. By 2007 and into 2008, Lehman was reporting billions of dollars in losses tied to its mortgage portfolio. These losses were not just accounting figures, they signaled deeper structural problems within the firm's balance sheet. Investors, analysts, and market participants began to question whether Lehman truly understood the scale of its own risk exposure. Confidence, which is essential in the financial industry, started to erode. As uncertainty grew, lenders became more cautious, and trading partners grew hesitant to do business with the firm. Liquidity, access to short-term funding, became increasingly difficult to secure. In the world of investment banking, where operations depend heavily on continuous access to capital, this loss of confidence proved devastating. The collapse, September 2008. By September 2008, Lehman Brothers had reached a critical breaking point. The firm was running out of options, and time was no longer on its side. Behind the scenes, urgent efforts were underway to find a solution, either through a sale to a stronger financial institution or a government-backed rescue. Potential buyers were explored, including negotiations with major banks, but no deal could be finalized. Concerns about Lehman's toxic assets and the scale of its liabilities made the acquisition unattractive without significant government support. However, policymakers, including the Federal Reserve and the U.S. Treasury, ultimately decided not to provide a bailout. In the early hours of September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. It was the largest bankruptcy filing in U.S. history, marking the sudden collapse of a 158-year-old institution that had once stood as a pillar of global finance. The impact was immediate and severe. Financial markets around the world reacted with panic. Stock prices plunged as investors rushed to reduce risk. Uncertainty spread rapidly, and trust within the financial system began to break down. One of the most critical consequences was the freezing of credit markets. Banks and financial institutions, unsure of who might be holding similar hidden losses, became unwilling to lend to one another. This lack of trust disrupted the normal flow of capital, which is essential for businesses, governments, and individuals alike. The collapse of Lehman Brothers acted as a shockwave that rippled across the global economy. What had previously been seen as a contained issue within the housing and banking sectors suddenly escalated into a full-blown financial crisis. This moment is widely viewed as the tipping point, the instant when the situation transformed from a serious but manageable problem into a global economic emergency. It exposed the fragility of the financial system and demonstrated how quickly confidence, once lost, can trigger widespread instability. Global impact of the crisis. The collapse of Lehman Brothers did not occur in isolation. It triggered a powerful chain reaction that spread rapidly across global financial markets. What had been building as a crisis within the U.S. housing and banking sectors suddenly escalated into a worldwide economic shock. Almost immediately, stock markets around the world plunged as panic set in. Investors rushed to pull their money out of risky assets, leading to sharp declines in equity prices and widespread volatility. Confidence in financial institutions weakened dramatically, and uncertainty became the dominant force in global markets. Major banks and financial institutions found themselves under immense pressure. Some collapsed entirely, while others were forced into emergency mergers to survive. Many required direct government intervention to prevent systemic failure. One of the most significant cases was American International Group, AIG, a global insurance giant that faced enormous losses due to its exposure to mortgage-related derivatives. Without a massive government bailout, its failure could have triggered even deeper financial instability. In response to the growing crisis, governments and central banks around the world took unprecedented and coordinated action. In the United States, the Federal Reserve and the U.S. Treasury implemented emergency measures designed to stabilize the financial system. These included large-scale bailout programs, capital injections into banks, and liquidity facilities to ensure that financial institutions could continue operating. Central banks lowered interest rates to near zero and introduced unconventional policies, such as quantitative easing, to inject money into the economy and restore confidence. These actions marked a significant shift in how governments respond to financial crises. However, the impact of the crisis was not limited to financial institutions. It quickly spread into the real economy. As credit markets froze, businesses found it increasingly difficult to access funding. Without access to loans and capital, companies were forced to cut costs, delay expansion, and, in many cases, lay off workers. Unemployment rose sharply across multiple countries, affecting millions of individuals and families. At the same time, the collapse of the housing market led to a wave of foreclosures, leaving many people without homes and wiping out significant portions of household wealth. Consumer confidence declined, spending slowed, and economic activity contracted on a global scale. International trade also suffered as demand weakened and financing became harder to secure. The world economy entered what is now known as the Great Recession, the most severe and widespread economic downturn since the Great Depression. Its effects were felt for years, reshaping economies, financial systems, and public trust in institutions. Why Lehman was not saved? One of the most controversial and widely debated questions surrounding the crisis is why Lehman Brothers was allowed to fail while other major institutions were rescued. At the time, policymakers faced an extremely complex and rapidly evolving situation. One of their primary concerns was the concept of moral hazard, the risk that rescuing failing firms would encourage excessive risk-taking in the future. If financial institutions believed they would always be bailed out, they might take on greater risks without fear of consequences. There were also significant legal and structural challenges. Unlike some other institutions, Lehman lacked sufficient collateral that could be used to justify emergency lending under existing regulations. This limited the ability of the Federal Reserve to intervene directly in the same way it did with other firms. Political pressures also played a role. Public sentiment was increasingly critical of bailouts, particularly after earlier interventions in the financial sector. Policymakers had to weigh the risks of intervention against the potential backlash and long-term implications. Efforts were made to find a private sector solution, including potential acquisitions by other banks. However, these negotiations ultimately failed, largely due to the scale of Lehman's losses and the uncertainty surrounding its assets. The decision not to rescue Lehman had profound consequences. Some economists and analysts argue that allowing the firm to collapse severely damaged confidence in the financial system. It signaled that even large, established institutions were not safe, which intensified panic and contributed to the freezing of credit markets. Others, however, contend that Lehman's failure was unavoidable. They argue that the firm's financial condition was too weak and that saving it would not have prevented the broader crisis, which was already deeply rooted in systemic issues across the financial system. Regardless of perspective, the collapse of Lehman Brothers marked a turning point. It highlighted the difficult trade-offs policymakers face during crises and underscored the importance of stability, transparency, and effective regulation in maintaining confidence in the global financial system. Lessons from the crisis. The collapse of Lehman Brothers revealed significant weaknesses in the global financial system. First, it exposed the dangers of excessive risk-taking and high leverage. Many financial institutions had taken on more risk than they could manage, assuming that housing prices would continue to rise indefinitely. Second, it highlighted the complexity and lack of transparency in financial products like mortgage-backed securities. Investors often did not fully understand the risks they were taking. Third, it showed how interconnected the global financial system had become. Problems in one part of the market quickly spread across institutions and countries. Regulatory changes. In the aftermath of the crisis, governments introduced new regulations aimed at preventing a similar event in the future. In the United States, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted to increase oversight of financial institutions, improve transparency, and reduce systemic risk. Banks were required to hold more capital, undergo stress tests, and limit certain types of risky trading activities. Central banks also adopted new tools and strategies to respond more effectively to financial crises. Lasting effects. More than a decade later, the effects of the 2008 financial crisis are still felt. It reshaped public trust in financial institutions, influenced economic policy, and changed how governments respond to crises. It also led to increased awareness of financial risk among investors and the general public. For many individuals, the crisis had lasting consequences, including lost jobs, reduced savings, and long-term financial hardship. The collapse of Lehman Brothers was not just the failure of a single firm. It was a pivotal moment that exposed deep flaws in the global financial system, driven by excessive risk-taking, complex financial products, and a housing bubble that could not be sustained. The crisis demonstrated how quickly confidence can evaporate and how interconnected modern economies truly are. Understanding what happened in 2008 is essential, not just as a historical event, but as a reminder of the importance of responsible financial practices, effective regulation, and the need for vigilance in an ever-evolving economic landscape.